Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of bringing on one of our favorite guests, Michael Oliver of Momentum Structural Analysis. How you doing today, Michael?
I'm doing fine, Darrell.
Yes, so obviously big news today at the time of this recording. SpaceX has launched on the stock exchanges, and it's one of the biggest IPOs ever. I'm curious in your thoughts on this, and is this a sign of a market bubble, market top, or anything of that nature? I mean, it seems very exuberant.
Yeah, it is, but these single event things, even as profound as this one is, they don't cause the major trends. Okay, a lot of people like to assign, oh, it's rallying because of this, oh, it's selling off because of this, on something that's temporary and passing. It's like the Iran war. Everybody took positions either way on that thing, stock market, gold, etc. And net on balance, you're going to find out it didn't mean a damn thing, okay, in terms of the major trends, okay. A lot of people probably got hurt buying that news or selling that news, either way, in whichever market they were in. I know the people that chased oil on the upside, probably most of them, we got long bullish oil in January at $65 on the futures. And most people didn't get along till March, probably when it was up near 100. Okay, Well, they're already getting their gut kicked right now. So anyway, I respect the notion that Elon Musk is driving on. I think he's largely a privatization guy. In other words, we go into the future 100 years from now, you look back and say, oh, the space was privatized, and one of the initiators of that was Elon Musk. And otherwise we might not be where we are, living on Mars or wherever, that it's not NASA that got us there. It's going to be stuff like this. So anyway, so I do respect it, but I have obviously I can't have a technical opinion of it. There's not enough history for me to run technical study. So, anyway.
Yeah, so when you look at the broad indices today, we've seen some pretty violent swings, a lot of volatility towards the upside, downside. I mean, you've mentioned, oil, like many people got positioned in oil late, and then oil has sold off and has been, subject to the whims of whether there's a peace agreement or not. And then you get the broad indices. I mean, there was a big sell-off recently. They've recovered a little bit, but and obviously there's these longer term trends and such. But then in the meantime, some people are losing their shirts and stuff. And so so I'm just curious of your thoughts on the broad markets right now.
Yeah, the entry point is very important. Where did you get in something, whether short or long? And if you got in at appropriate technical levels, then some of this turbulence is not hurting you. Yeah, you've given back some profits. For example, if you bought silver, our last three buy signals of consequence were $25 to $26 in March of 24, $35 area in June of 25, and our last long-term buy signal was at $56 in November last year. So when you average those guys out, you're probably talking somewhere in the mid-30s. So yes, you saw this brief spike well above 100, 120, but that was like phantom. It was like hours or a few days, that's all. And then this sudden drop, and then nothing for 5-6 months now. In fact, you can draw a line sideways through the middle of the gold and silver action and just see this, who's in charge action, up, down, up, down, up, down. And all, people are taking these headlines and acting on them. Same with the stock market. But broadly speaking, I think the stock market is topping. It may have made its high with that 7,600 reading on the S&P. We dropped down to 7,200 and change this past week. Now we're back to 74. We think the stock market is vulnerable for a major bear trend. It's likely to generate one that people will finally recognize as a bear trend later this year, but especially if we get into the third quarter, meaning a few weeks from now. There's the potential for some vulnerability that could be a real kick in the shins for a lot of people. I don't mean a crash, anything like that. I meant just, a jolt that, oh, what's going on here? Not even any headlines to explain it, et cetera. And the opposite for gold and silver. I think they've been caught in a range that most of the damage was done in a day and a half. You go back and look at January 31st, February 3rd, last day of January, first day of February. And that was effectively circle that February 3rd low on silver, draw a line sideways. Circle that low on gold, draw a line sideways. Yes, we've been above and below it, but really not trending, just violent, confusing swings to most. I think that's now wrapping up. And we've got some numbers, I won't be too specific because they can vary week by week, day by day, but you continue this week's reversal type rally we've had in the monetary metals, at least, in some of them it's total reversal up on the week. Silver barely closed down on the week. And gold, in 2 days has rallied $200. But that bounce, I think if it goes just a bit further, not a lot, you don't have to get up to like $85 silver or 90 or anything like that. We're going to trigger enough stuff that says, hey, this rally is going to be different than those other rallies that occurred within that range. This is not just another dud rally. That this one could launch through the entire congestion zone and get us going into a very steep angle of ascent. I think we're on the cusp of that. We'll see probably in the next week or two.
Okay. So you mentioned that by sometime in Q3, the markets could run into some major headwinds, the broad indices, the stock market. Do you have a catalyst in mind for that, or are you just looking?
No fundamental needed. The fundamentals are in play already. One thing we do is we study the relationship between asset A and B, and in the case of the stock market, generally over the last several years, many of the sectors have been at least par performers to the S&P, meaning as it went up nicely, they went up nicely. Not better, not worse, so par, meaning their performance was the same. Owning the XLF would have been about as good as owning the S&P. That suddenly started to change some months ago. So, for example, the financial sector, which is an essential sector that's largely overlooked right now, everybody's looking at AI and NVIDIA and stuff like that. Its relative performance to the S&P is collapsing. Now, you don't see it on a price chart of XLF. All you see there is dud. In other words, the S&P made new highs recently. It didn't. It had a secondary high. But when you plot the spread relationship between that essential sector, a sector the Fed cares about, okay, big banks, broker-dealers inside that ETF, insurance company, et cetera, especially the big banks, you got to watch that sector because that's where the headlines will come that people aren't looking for. That's sort of, and at best kind of ambush is one that you don't expect it to come from. Oh, it came from over there and I wasn't even aware of it. And the spread relation between XLF and S&P right now is doing what it did back in 2007. As the market was making an all-time new high in October of 2007 when Fed cut rates, surprisingly, XLF, financial sector, was not making a new high. And when you plot the spread chart relation, meaning divide XLF into the S&P, express that as a percent, and plot that each month. If you plotted that chart, you would see XLF was blowing through a multi-year floor of relative performance to the broad market. No, you look at the price chart, you didn't see anything drastic, but the spread was saying, hey, I'm collapsing in relative value to the stock market. This all occurred before the stock market really started down in a way that people said, oh, it's going down, and we're seeing that now. So it's something we're paying attention to. And then within that sector, we're watching the big banks. And frankly, if you look at, for example, KBE, which is the bank ETF, large banks, not regionals, you go back to 2022 in price, so 4 years ago, and look where it was. You're about 5% higher than you were then. 5%.
Wow.
4 years. In other words, yeah, it's been steady and up with the S&P, but it ain't going nowhere, okay? What's going on there? How come it's so anemic? Anyway, that's a tell, and I think you got to watch that. And I think ultimately, I know what ultimately drives gold and monetary metals is the decay in money. The real buying power of the fiat currencies is constantly collapsing year by year, decade by decade. So, when your granddad built a house, it was $4,500. Your dad, $45,000. Median home now is $450,000. What's going on there? Decay in the value of the money. That's all it is. It's not an increase in the real value of homes or the price of bread or the stock market even. You go back and measure the S&P versus where money supply was, certain decades ago and then say, is it really making money? The one that's been constantly holding its value as an asset is gold, period. It's money, okay? And if the Fed starts to panic, again, not based on one of their mandates, but based on one, U.S. government bond market's in trouble. Japanese government bond market has already been in trouble. This is different than 2007 through 2009. It was mortgages then. This time it's government debt. Like Jamie Dimon said several weeks ago, we're facing a government bond crisis and we're going to have to deal with it.
Yeah.
And we technically agree with him in terms of the timing of that statement. Well, that's something the Fed can't. It's not a mandate, but they've got to defend that beast. And already they're taking steps to defend banks and try to buy. They're buying bonds ever since November, according to Williams, the head of the New York Fed. He said, we're going to start buying bonds to provide, quote, liquidity. And actually, it hasn't supported it. Bonds have come down, yields have gone up. So anyway, I think that's the thing you got to watch right now. And when that starts to unfold in a more obvious way, government bonds, U.S. stock market, that's when you look across the horizon and say, well, where's the best place to be? There's only one category left, monetary metals.
Yep, the real stuff, the real money. So I remember I watched a clip of Hank Paulson, the former Treasury Secretary, coming on and talking about the government debt and the bonds, finding the buyers for the bonds being an issue as well. So, I could definitely see that. I mean, especially if Jamie Dimon, is mentioning it as well.
Oh, yeah.
I'm curious on your thoughts on the recent inflation, obviously into money supply and the erosion of the purchasing power of the dollar is how I typically look at inflation. But we have these CPI, PPI numbers coming out hotter and such. And so just curious in your thoughts on those.
That puts the Fed in a predicament because that's one of their mandates. They're supposed to fight inflation, for wrongly defined inflation. Rising prices in assets, whether it's stock prices being driven up by money flows or commodity prices, in this case, like CPI and wholesale prices, especially recently oil, although oil is collapsing now, as we kind of expected it would. Still, that number, it forces them supposedly to have to raise rates. And people think, well, if they raise rates, that's going to hurt gold. Well, historically, that has nothing to do with gold. You go back to 74 through 1980, the Fed raised rates like a maniac. 14% short-term rates. Long-term yields went from 7.5% to 12.5%, 30-year bonds. And yet gold exploded, okay? But anyway, so they're supposed to fight inflation wrongly defined. But when you look at an M2 chart, they're not fighting inflation, they're increasing it. So it's a lovely vertical bull market, the money supply. You wish you were on board, right? Well, if you're in gold, you're on board. That's the real issue. And then the other one is, of course, unemployment. The other side, the other mandate. And they think, looking at the data, because the unemployment number is sort of flat, and they think, oh, that's okay, we can live with that. It's not a bad number, it's not getting worse. If you go back and look at stock market tops and overlay an unemployment chart numbers, get them from the Fed of St. Louis, and overlay the chart, you'll see that the unemployment rate didn't really start to rise in a way that would alarm the Fed until well after the stock market had already peaked. It was like 20% off its high, headed south. Then suddenly, those data points got in gear with the stock market. It's not the other way around. So when you look at that thinking, well, what's the stock market going to do because the Fed will do this? No. It's not. The Fed, again, is quietly, but no doubt unnerved by what's going on in the government debt. That's their overriding implicit mandate.
All right, gotcha. Yeah, appreciate those thoughts. So there was recent news with the CME launching weekend, like 24/7 futures tradings on gold, silver, oil. And I know that there was a lot of speculation and concern about the manipulation, the paper price manipulation of the metals and such. Do you think that could be problematic for the movements in gold and silver? Or do you think
it's just it's a minor noise element on the side. You're going to hear a lot of stories about supply demand increase or whatever. China's doing this, or the issue you just brought up about futures versus real bullion or whatever. The Chinese pricing versus our pricing of silver, big difference there. All these things are just going to be rumbling around on the side. Some positive, most of them probably positive, but some negative. People can say, "Oh, that's all that matters." No, it doesn't. What matters is the ongoing decay in the money unit, and silver is money. People think of it only as an industrial metal now, but it moves with gold. It does not move. If you go back and look at the Bloomberg Commodity Index, for example, they think, well, silver moves like a commodity. No, it doesn't. It moves with gold. Now, often it moves with gold to a lesser extent. Meaning gold might have a good move and silver has a good move, but less than gold. Right now, that has totally shifted. That changed back last November. Silver broke out relative to gold when you plot a spread chart of the two. Broke out over a 10-year range. Still very dirt cheap. So is this money supply is the real issue. As that increases, because the Fed has to print to save the bonds. And I take that quote from the Prime Minister of Japan, who was elected a year or so ago, and she said, she's supposed to be a conservative type, we're going to print to save the bonds. Well, I mean, it's increase the money supply. Well, we take the book from Japan all the time. Bernanke did back in 2008, after we crashed the stock market in October, a full year off the high. 2007 in October, 2008. In October 2008, you had like a crash month, and Lehman Brothers went out the month before. Finally, Bernanke said, screw it, I'm going to do QEs. Took a book out of the Japanese, page out of the Japanese book. We're doing the same thing now. So really the main issue is not this, that, or the other short-term metric like commitment to traders report or open interest in the COMEX, so forth and so on. Reality lives underneath all that. And ultimately these seeming deviations or whatever you might see, they're going to be flushed out of the way. And also manipulation will too. I mean, if silver was manipulated, and I can buy that argument, I'll tell you why in a minute, but it's no longer, it's saying, I'm out of here, guys. I'm not going to stay in that 50-year confinement that I was in. Heck, copper didn't stay in its. Copper was in the range for decades between 50 cents and $1.50 a pound. In late 2005, it broke out, and you know what happened? In several quarters, it quadrupled in price. Several quarters, $4.10. Now we're $6.30. Okay. Same thing with lead. Lead did the same thing. A multi-decade sleepy little range like silver had, $5 to 55 to 55, etc. Lead broke out in 2010, quadrupled in several quarters. Went to a new reality. Boom. Didn't even have headlines. Now silver broke out of that $50 range, and we're not that far above it now. You know, we're $69, $68 right now on a pullback. It is yet to reach its new reality, and our assessment is on a variety of reasons. Technical, archival history of other markets that have done the same thing, like copper and lead. Silver go to 300 to 500 and do so very rapidly. In fact, my bet is you come out of this congestion zone that we're in. Let's say you show the evidence of that in the next several weeks or month. Our momentum evidence, you don't have to wait for price to go to 100 to prove the issue. And I think you could be in that zone within a handful of months. So all these issues you raised, they're noise. You know, And whoever tried to restrain silver for 50 years, copper wasn't, gold wasn't, lead wasn't. How come silver was stuck in a 50 range? What's wrong with it? It says, hey, no more. I made a mistake. I'm coming out of here. And I think it's in a tantrum. And we've not even seen the tantrum yet.
Yeah. What are you seeing on the momentum basis for silver? I know that's the metric you track, and you've followed that closely. What are you seeing there?
Well, we measure all markets on different timescales. The main emphasis for an investor is long-term trend momentum, not what happens this week or next or the next 3 or 4 or 5 months. That doesn't matter unless you're a trader, okay? If you look at silver and gold since 2015, they've risen nicely, okay? Silver far more erratic than gold, but nevertheless an upward bias. And if you flicked out of your position every time there was a shakeout of double-digit percentages, thinking, oh, that's it, you were wrong. Because the real problem then is once you got out, assuming you didn't sell the top tick of the congestion zone before the congestion occurred, where did you get back in? Or did you get back in? And I bet if you got back in, you got in higher than where you got out. Okay? Mm-hmm. So, in other words, the guy who did better looked at long-term factors, and we look at long-term momentum like silver and gold's annual momentum. What's that? It's when we measure each month's action in its oscillator relationship to, let's say, a 36-month average or a 3-year average. When we plot the bar, where is it in relation to that? Not on a price chart, but on an oscillator. And are you above it or are you below the zero line? And when you plot the oscillator, there's been no breakage in this break. It's a sharp break, but still in the context of an ongoing long-term momentum uptrend. The only thing that broke in silver and gold in that January, February break, day and a half collapse, you broke intermediate trend factors. So you cracked a knee bone and you slumped. But if you really look at what's happened since then in the healing process is sideways on price. Up, down, above that low. In fact, silver right now is above the Feb low. Feb low was $64. It was 6 months later, 5.5, 6 months later. And where are you? You're still above it. Mm-hmm. Okay. Gold's slightly below it, $150 below it. But the point is that what we've seen over the last 5 months plus is a healing process by what was broken, intermediate trend factors, intermediate and short term. Nothing has upset the investment grade decision to be long silver or gold.
Okay. So right now, silver, just as you mentioned, like it's hovering around that 64 and above. So how long could you see this consolidation happening?
I think it's probably ending now with this week's low. Last week in our weekend report, we suggested, especially regarding the miners, because they made a prominent low back in, I think it was March. It's when silver made its low at $61, by the way. When it swept the February low at 64, nothing happened, silver immediately shot back up. The miners broke through that price low. So anybody looking at a price chart said, oh, that's it, it's over with, that's the top, et cetera, et cetera. You close the week back above it. Or you blew through the low, ran all the sell stops, and reversed the week, closed back above that low that you broke that supposedly was the end of the world break. Okay, you're going to go down forever. I think that was probably the flush low in the monetary metals, this week's action. And it's not going to take much, follow through next week, to trigger enough intermediate trend momentum factors, the ones that were broken back in that Jan-Feb break, to say, okay, we've righted that issue. We're now, the intermediate stuff that was broken has now healed itself. It's now positive and it's rejoining the long-term trend because they were in opposite trends. One was still positive. One said, I'm negative now. I think the intermediate's about to shift back to positive, at which point then we'll pound the table, define it with some numbers, and suggest to people that the rally you're seeing is not just another rally. It's this time you're coming up out of here. I think that's where we are. Period.
Yeah. So with the miners, I feel like I've been actually accumulating more of the mining stocks.
Yeah.
I did buy a little bit of physical silver and physical gold on the recent price action, but the miners seem to be like just getting oversold. And so, just curious in your thoughts on the miners. It seems like they're struggling a lot more.
Yeah, they've recently struggled a lot, but when you stand back and measure month to month and go back several years, they're beating gold.
Mm-hmm.
Beating gold. Okay, and what's overhead when you plot the pricing of the miners relative to an ounce of gold? And we go back to the 1980s and do this with the XAU index, which is the Philadelphia Gold and Silver Miners Index. It's been around since the 1980s. And you plot where that was in its relation to an ounce of gold, divide XAU price into gold, express it as a percent, plot it month to month. For multiple decades, it was in a relative valuation of about 25% of the price of an ounce of gold. Up and down, like to 35% at times. It got down to 17.5% a couple times. So, but median for decades was 25%. In 2015, when the bear market ended in gold, silver, and the miners, the net price, it got down to 4%. Okay, something that used to be 25% on average went to 4%. What do you think it's going to do? Go to zero? Okay, you want to buy low? Just forget whether it's a buy then or not. It's off the page priced low relative to that which it gets out of the ground. Right now it's trading either side of 8%. So, meaning since the bear low in 2015 to the present, over 10 years, the miners have basically doubled in relative value to gold. Despite the upward curve you see in gold, there's also one in the miners, but they're actually at a relative level that's double where they were in 2015. So 10 years of investment in gold, you'd have done better in the miners, despite what you think about how they're behaving. There still are, even with this recent break, they're outperforming. If you get above the recent highs that we saw in the XAU index versus gold, or even we measure GDX versus gold, there's been a range for the last 10 years, the upper end of that range. They've punched at it and punched at it and punched at it. You go much above the recent spread highs that we've seen. Like you get XAU up to about 8.6% again. You get GDX up to certain levels that would be comparable. They're going to break out of this 10-year base, which they're now at the top end of relative performance. Still very, very cheap. XAU is like 8%. It used to be 25, okay? You break out of that spread base, the relative performance, then you're really going to gush the miners on the upside relative to gold. They could double or triple in relative value to gold. That's what we think is a better place to be. So watch gold, but I prefer the miners, especially silver miners.
Yeah, for sure. Yeah, that's definitely where I've been parking majority of my capital here in the recent days. So where do you see gold heading on a momentum basis?
We don't have a firm target except to say this. I've said it many times, probably to you in an interview before as well. If you go back and look at the bull markets of gold, the gold is generated since it was legalized in 1975. Both of the bull markets, different price zones, different time spans, were eightfold gains from bear low to bull high. Eightfold. 1976 low to 1980. 2001 to 2011. 8 times the low of the bear market that preceded it. Our bear market low was 1,050. It means you could go well over 8,000 just to simply match what gold has done twice before since it's been legalized. Okay, that's no big deal. It's saying, oh, I did it before, I'll do it again. Okay, big deal. 3 times. The fundamentals out there and the technicals say, no, you might go a lot further than that. But at minimum, if you went there, that's not really overdone. It's something you've done twice before. Silver, on the other hand, hasn't done that. It's only recently that it managed to get up out of that range. It's like, gold went up to 850 in 1980. It's like silver is only just now, late last year, finally taken out that high of 1980. Okay, gold took it out twice now, and I think silver's going to go in a tantrum type way to a new reality to get more relative valuation to gold than it currently is, which is like 1.6% of an ounce of gold. I think it could go back up to where it was in 1980, 6.5% price, meaning, quintuple its relative value to gold. So that again emphasizes, and the technicals verify this, the technicals of silver versus gold say buy silver, not gold. That the place to be in the monetary metals now is no longer the mama metal, it's silver and the miners, with an emphasis on the silver miners.
Yeah. Yeah, gotcha. So, do you follow the platinum group metals?
Yeah. Platinum group metals are not monetary. People like to call all the metals precious metals. Gold and silver are monetary metals. They've been money for 3,000 years. Platinum is a precious industrial metal. If you study platinum going back through the decades, it doesn't always sync, probably 50% of the time, sync with gold, in synchronization with gold. Platinum only just woke up out of a multi-year basing range at very low levels last year. Heck, gold woke up long before that. Okay, if you look at the Bloomberg Commodity Index and platinum, you'll see that is where the synchronization is. So if you want to know why is platinum going up, it's not because of gold, it's because the overall Bloomberg Commodity Index has risen and it moves sometimes a lot more, sometimes less than does the overall commodity complex. Same with palladium. And they're in positive sync. They're getting a pullback now, just like gold. So is the Bloomberg, but it's in a very positive trend. And we got bullish, for example, on the Bloomberg back in October of last year at 106.50. Right now it's 130. Okay, yet nobody's pounding the table about the overall commodity complex. They think it's just oil. No, it's not. Oil's a laggard, in fact. It only broke out in January by our metrics. So, but platinum is part of that category. So don't confuse it with gold. Yes, it's positive. Yes, it's having a pullback. Yes, you're probably near areas on platinum where you could look at it and say this is a relatively safe place to accumulate.
Okay. And oil. So oil rallied, pulled back. There's a few different thoughts on this. Some folks think as soon as the agreement is announced between the U.S. and Iran that oil is going to plummet. Some are saying it's going to $250 a barrel. And then some have the longer term view that oil has been underinvested in for a long time. And that
it's definitely an underpriced commodity asset, just like the Bloomberg Commodity Index. I mean, you go back to 2008 and the Bloomberg was 237. Right now it's 130. It's hardly an explosion in commodity prices. You're still half where you were back then. And you're very low priced in relation to other assets. Now you look at crude oil, it made two bull market peaks at 140 and 130. Where are we now? 84? Okay, that's not overpriced. It's even low relative to its own history. It's very low if you plot, let's say, the crude oil versus, let's say, the S&P. Go back decades. It's off the page priced low relative to that asset category. And we think that the shift favoring commodity assets, not just oil, by the way, is now underway. And the unfortunate thing about oil is it got bid up by crazy headline chasers. And they're getting gut kicked already. We're back to 80 in the mid 80s. We were at 117 twice in the recent rally. Again, not above the old highs of 140 and 130, but still, those guys have been gut kicked really good, and they may get some more. We got a buy signal at 65. I don't think you're going back to our buy signal level in January, but I do think you could easily see 80 or slightly below in this pullback, which is already somewhat pricing in what you said, that there is some kind of solution or quietness of this situation where the oil fever breaks. But I don't think it's going to break you back down to $60 again. So it's this pullback in oil that I would be looking at as where it will regroup, but higher than our breakout level at 65 in January, and start back up, this time without a silly headline. Just the vast underpricing issue, and that all commodities in general are tending to rise because they're dirt cheap historically. And when money moves, it's never the case in market history. Go back 100 years, especially when the Fed was founded 110 years ago, and look at stock market drops, bear markets. Everything doesn't go down. Almost always, in fact, always, gold goes up during those major trends. There might be an interruption here and there in the gold uptrend, like it was in October 2008, but basically it goes up when stocks go down. So, and usually T-bonds go up as well. That ain't working anymore. And we've had CIO of Morgan Stanley several months ago said, 60-40 rule's gone. It's now 20% bonds, 20% gold, 60% stocks. And he's been concurred by other people. I think when you start to break the stock market, that's going to create not all the money gets caught on fire and burns up, okay? It moves. And it's going to go where it sees better behavior. And right now, if you look at commodities, forget the oil component. It's not been explosive yet. We're 130 versus 106 since October's close. Yeah, that's pretty good advance percent-wise without any headlines. It's because most commodities within it are doing this, So I think that will benefit overall the commodity complex. And from an investment perspective, they won't be as good as gold or silver, especially not, let's say, for this year. But I think over the next several years, those who invest in commodities and commodity-related stocks will do just great.
Yeah. I'm curious with like the recent moves in oil, obviously you had speculators come in, price gets bid up significantly once the war in Iran started. And then, but you also had like countries around the world like releasing from their strategic reserves and to try to cap the price. And so it seems, but they don't have unlimited reserves to just keep releasing forever, and so.
That's another factor, yeah. No, and it is the guys who are talking 250 oil, it wouldn't shock me at all, even higher. Not right now, not necessarily this year, but it's not a silver situation. Silver's in a catch up to an unreality situation it's been in for a half century. It's saying, hey, I made a big mistake. I underpriced myself for decades. I'm going to reprice. And when it does, it can often be emotional. Markets do that. They make mistakes. They get too high for too long, they collapse. They get too low for too long, they explode. I think silver's in that. Commodities will advance, but I don't think it's going to be explosive. I think it's going to be investment grade type of advance. And oil will be one of them. And I don't have a target except to say that our breakout based on long-term metrics only just occurred in January.
Yeah.
So it's not old. Could last years. Likely will.
Yeah. Okay. And lastly, I want to get any updated thoughts you have on the emerging markets.
Broadly speaking, that's a better place to be than certainly the U.S. market or the Nikkei, which are bubbles. A lot of the emerging markets are more commodity connected, and therefore that helps them, like let's say Brazil and so forth. So on a relative basis, I would prefer them, because to some extent they're buoyed by their commodity output. I don't necessarily have the firm opinion that they'll net go up in price. But if you had $1 million and you split it in half, you short of 500,000 S&P and buy 500,000 of mixed emerging market ETFs, I think the spread relationship would make a ton of money. Meaning they might both go down, but one goes down a little, one goes down a lot. You get my point. The spread difference is what matters. Yeah. So I would prefer emerging markets, and they might, in certain cases, actually advance nicely. We're looking at that.
Okay. Any other markets outside of Brazil that interest you?
No, just in general, the emerging markets. EEM contains quite a few Asian markets. China, for example, which I think is a pretty good chunk of the percent of EEM is China-based. China's gone up and down with the S&P since 2009 bear low. But S&P is like 11, 12 times where it was then. NASDAQ 100 is like 24 times where it was in 2009. So they're massive bubbles over a 16-year span. Same time span in China, Shanghai Composite, it's double and a half. So yes, while it has the kind of trend structures that could break to take it down. In no way does it look vulnerable on a percent basis like what the S&P looks like. So on a relative basis, China, though in broad sync with the S&P, doesn't look vulnerable on a percent basis. So because that's a heavy input in EEM, for example, the emerging market ETF, I think it's like 30% China based. That would at least keep EM from going down as much as the bubble markets, like India is a bubble market, Japan, certainly Nikkei, and the S&P and the NASDAQ here.
Got it. Okay. Well, Michael, thank you for coming on the show, giving us your updates and commenting some of the markets. Some of these investors in the metal space need some common sense shared with them sometimes, especially with the recent volatility. So thank you for coming on, giving us your insights. Where can people connect, subscribe, all of that?
OliverMSA.com. Oliver MSA for Momentum Structural Analysis. And request some sample copies.
All right. Well, you all have the information. Be sure to hit the subscribe button if you haven't subscribed yet. Love to have your support. And thank you, Michael, for coming on the show.
Thank you, Darrell.